Xin chào everybody, welcome back. You're watching Vietnam Steve, and some people there think I'm filming them, but I'm not. And I've got a good one for you today. So I just got to get across the road here, and then we'll be right with you. Okay, let's make a break for it. We'll go, we'll let that limo bus go. The plan of attack is to get to the middle here. And this is pretty okay this way. But of course, the other side of the road here is going to be a bit of a shit show. So a lot of you have been asking about my portfolio arrangements, and he stops and lets me through. And so I thought I'd let you know where I'm invested, how I manage all of that, and why it works for me. I've brought you across to Flower Park today because a little bit cooler over here, and also haven't been down here for 6 months or so. So I thought it'd be nice to take you around the park and show you the garden here, and people taking photos and ladies doing Tai Chi or whatever. It's about 10:30 in the morning today. Got going a bit later today, and it's cooled off a bit. So I think there's rain coming, but regardless, I'll see how I go around the walkway here. Now this is an interesting park because there's a nice walkway up the top there, you can see, and I've gone around that walkway up there 3 or 4 times, and every single time I've gone up there, I've stuffed up the recording. I've not had the microphone on. I've lost my AirPods, all sorts of things. So in fact, I better just check that I've got the microphone on here before I launch into this one. It's our lucky day today because we've got a lot of Japanese anime sort of people down here doing some photos, and they're looking $1 million. So I've got a portfolio of investments, less than $500,000, and I'm focused on a 70-30 stock defensive allocation. And the 30% is also got some inflation protected assets in there as well. So what I want to do is make sure that I've got plenty of growth happening, and I'm resilient to risk of having to sell in a down market. Now, of course, I've got a little bit of income coming in, so no selling required. And I'm going to head over to the right and just get out of this sun because I'm going to get fried here. My current portfolio structure is I have everything in a managed mutual fund, 100% high growth, but that has some defensive high growth as well, things like alternatives and private equity. And so effectively that's an 85-15 fund. And so that's where I stack, and money's, some people say money's made round to go round. I believe it's made flat to stack. I'm going to sit under the tree here and just run through this one with you because it's quite hot out in the sun. I'm surprised. I didn't bring the crazy hat with me today, so don't know what's actually going to happen. So essentially, probably 60% of my funds are in the high growth managed mutual fund. And then I've got some cash, and I don't have much cash. I keep about 10 grand on hand. That's for emergencies, anything that I might need to splash out on, or anything that catches me by surprise. So I'm running on about 10 grand cash, and replenish that when I need to. Separate to that, I've got another 10 grand in Australian government bonds, and also inflation protected bonds. So essentially I've got 30 grand on the side if we have a SHTF moment and we need some coin, etc. And 30 grand is probably about my annual spend. So I've got about a year's worth of cash on the side for those of you that are counting, and I know you all will be. The main thing for me is that also adds to that defensive aspect, bearing in mind I'm 100% high growth. So how do I defend against an unexpected market fall? I've prepaid all my living expenses. So anybody that sends me a bill, I've paid it for 12 months. So that could be house insurance, car rego, medical insurance, etc. I've paid that for 12 months, and essentially prepaid expenses is another way to defend against an unexpected market crash. So I've got my cost of living covered with my 30 grand of liquid assets. I've prepaid all my bills for 12 months. I've just got to buy food, and I think I'm fairly resilient. So with that kind of allocation, we're pretty much looking at, and I've got some notes here I'm looking at, ChatGPT's told me I'm looking at about 77% growth and 22% defensive assets. So I'm probably a 77-22, and I'd like to be a 70-30, obviously, but I do have some income coming in, so it's not as imperative as those of you that are in full retirement. How do I rebalance? Got sweat running in my eyes here, that is starting to sting. I don't know what that is. Must be the beer coming out from last night. I'm sitting in the park here, and if you could see what I can see, I'll just spin you around. I'm right opposite, I'm underneath a walkway, and I'm right opposite the bay here, so this is fantastic. I don't really rebalance. I rebalance by my small annual contributions. I'm directing new money to whichever side needs it to head towards 70-30, but I'm at 77-22, which doesn't add up, but that's what it is. So I'm trying to maintain my growth assets up at the 75% mark, but you know, it does vary depending on what the stock market's doing and how things are going. I'll rebalance on my birthday every year, which happens in May, so I don't have to do anything. You know, if I've got 30 years of retirement, let's hope I live to 90. I've got 30 rebalancings to do, so I don't fuss about it too much. In May every year, I'll rebalance that portfolio to wherever I need it to be, and make sure we're still on track. I'm a set and forget sort of a guy. So of course, because I've got that cash buffer on the side, I can also take advantage of any market drops. So if we have a market drop of 15 or 20%, well, that's a buy signal for me. So I'll probably drop some of that cash holding and buy some more equities. But essentially for me, the risk that I can bear, which is my risk tolerance, is a high growth portfolio. Now, it won't work for everybody, but it does work for me. Don't rely on any of this for your financial advice. This is entertainment. While I'm talking about entertainment, please like and subscribe to the channel. Particularly subscribe, because that's the only way I know you get access to the latest entertainment. What else did I want to talk to you about? Oh, the key principles. So the key principles are, don't need any income from my portfolio, because my small income basically covers my expenses. I don't, I spend 30 grand. So what's that? 3 grand, 2.5 grand a month Australian. Do the maths. That's probably, I don't know, 1,800 US probably. I've prepaid expenses, and I have some defensive assets, which all gives me basically a 1 to 2 year buffer against a SHTF moment. I've got a high growth option in a managed mutual fund with lowish fees. They're not the lowest fees, but they're basically returning 1% more than the balance 60-40. So I'm aiming for that 1% more, and I'm taking the risk on that, and that provides long-term capital appreciation. My bond and inflation-linked holdings hedge interest rate risk and inflation risk. So I feel like I've got a little bit of coverage there, and they're outside my retirement fund, so I can adjust those at any time, and they serve as an emergency fund as well. So, you know, if I have to pay out something unexpected, I've got the money for that. Last but not least, I've kept my rebalancing rules emotion free. Essentially once a year in May, and then if we have a severe market downturn, just take advantage of the market going nuts. This is quite new here, this one. This has gone up in the last couple of months. Got a nice big statue behind me. Try and get that in the middle, which means get me in the middle, and then I'll spin you around because this statue's looking straight out at Halong Bay. So there we are out there. What a great view. So there's a couple of things I have to do to get this where I want it to be, and so you know, ChatGPT's helped me out on that. I'm going to go back the exact way that I came because I need to get under cover before I fry. I need to rebalance some money into the defensive assets. I've got too much in the growth. I'm running at about 85% growth. I want to be running at about 70. The high growth fund runs at about 85%. I'm running at about 77, and I probably need to run at about 70. But I have to say I'm not losing too much sleep over it. I've got an income surplus, so I make more than I spend, or I spend less than I earn. So who would think that's a great place to be? Spend less than you earn in life, and then when you're in retirement, spend less than you earn in retirement. So effectively no change. That's my 100-year retirement plan. So I use that extra income as an informal rebalancing buffer. And then ChatGPT tells me to review my asset allocation every 2 to 3 years because maybe my risk tolerance will change, or maybe my risk appetite will change, and I'll be able to jump on board with some more. Sing Chow. I'll go exactly back the way I came because I need to get out of the update on my investment strategy, how much I've got and what the hell I'm doing with it. And I hope it's given you some ideas for your own portfolio. And I don't need a lot, I just need more than I spend. It's pretty simple. So it's high growth for me, and that's because I'm going to need to have income for the next few years. I've got some young kids in school, and so I've got to pay for that. And so I figure I'm not going to be drawing on that anytime soon. I'm the kind of guy that loves what I do. So sitting back and watching Netflix 6 hours a day is not me. I'm almost up at the coffee shop where I'm going to sit and have a coffee this morning, and we'll see how we go. Thanks for watching. Stay frosty. Like and subscribe to the channel. I really love your comments. I love all the people that tell me what I'm doing wrong. I appreciate that. That's free guidance for life. Please comment and subscribe on your investment portfolio, and I'll see you in the next one.